All right. So thanks everyone for joining us today. This is Finance Fridays, and I'm Scott Borowski with UC Riverside's Epic Small Business Development Center. We have our special guests today from Early Growth Financial. David's coming out of the Bay Area and Regine's in LA. I'll turn it over to them in just a second for their intro and we'll start the presentation. We're gonna have a Q&A ongoing during this deck that David's gonna be presenting. So you can, there's a little Q&A button for those of you who haven't used Zoom a lot. Just click the Q&A button, type in your question, and then when there's a good point to interrupt David, I'll interrupt and ask him the question, and we'll get the questions answered in real time. And then depending on how long we take to get through the deck, we also may have some time for questions at the end. So with that said, I will turn it over to Regine and David. So you can go ahead and take over sharing, Regine, and the deck should pop up.
Thank you, Scott, very much. And I do think we'll have some time at the end for questions. It typically takes 30 to 40 minutes to get through this presentation, so we should have a lot of time at the end. But also, please do ask questions. The more you ask questions, the more interactive this is, the better off it will be, the more interesting it will be. We're going to be talking about accounting, so anything we can do to make this livelier is a good thing. Anything we can to sort of spruce it up is a good thing. So my name is David Ehrenberg, and I am the CEO and founder of Early Growth Financial Services. And Early Growth was started almost 12 years ago. And the way that I always describe Early Growth is that what we do is not very sexy, but we do it in a very sexy space. And the not sexy thing that we do is we are an outsourced finance and accounting organization. So in the same way that Facebook or Cisco or Apple has a CFO and they have a finance and accounting organization underneath them, we do the same thing for our clients, but on an outsourced basis. And there's really 5 key things that we do. And the first thing we do is CFO services. We have 47 CFOs, and they do everything a CFO would do at a normal company, but they do it on an outsourced basis. So they do budgeting, financial forecasting. Our CFOs tend to do a lot of fundraising. They manage the accounting function and the CFO relationships, but they do it for multiple clients at the same time. So that's the first thing we do. The second thing we do is transactional accounting. We have 95 senior accountants and controllers, and they do all the day-to-day blocking and tackling for our clients. So they do a formal monthly close in accordance with generally accepted accounting principles. They prepare financial statements. They take care of all the general ledger entries, accounts payable, payroll, all those types of things. So that's the second thing we do. The third thing we do is compliance. So we have a large tax team. So we do state and federal taxes. We do R&D tax credits, sales and use taxes, and then we help out with all the other compliance issues like business registrations and business licenses. The fourth thing we do is valuations, primarily 409A valuations, which are common stock valuations for folks that have work for a privately held company that have stock options. And then the last thing we do is fund accounting and fund administration for about 50 smaller micro venture capital funds. So those are the 5 things we do. Not incredibly exciting, not incredibly sexy, but the space that we're in is really exciting. At any given time, we have about 700 to 800 venture capital backed companies that we work with. 18%, or almost 1 in 5 of all venture backed companies in the country are clients of ours at some point in their life cycle. We've worked with companies. We have a slide, don't we, Regine, that has a bunch of the companies that we've worked with, but we've worked with Clout and Formspring and Allbirds and Stitch Fix and Indiegogo and Goodreads and Credit Karma and a bunch of companies that have gone on to be really big, but when we worked with them, they had 5 to 60 employees. We're in Seattle, Portland, San Francisco, Silicon Valley, LA, Chicago, and New York. We're 3 months into a launch into Boston when the pandemic happened, so we put that on hold. I introduced myself a little bit. My name is David Ehrenberg. I'm the founder and CEO. And on the call with me, and I did this out of order, Regine, didn't I? But sorry. On the call with me is my good friend and the woman who runs our LA market for us, Regine.
Hi, everyone. Thank you for joining us today. And as David said, we at Early Growth help mitigate risks from a financial perspective to early stage founders and their companies. And I will let David take over in terms of this, startups, accounting for startups right now.
Accounting for startups.
David, I just want to mention we had a bunch more join in the last couple of minutes. So for those of you that just joined, this is Scott with UCR, and you can type a question in the Q&A, and I will ask in real time as we go through the deck. And then, as David said earlier, we'll also have some time at the end for questions as well. But feel free to type your questions in so we can get them answered as we're going through the deck. So if you have any questions, there's a Q&A button on your Zoom interface, and just click that and ask away. So take it away, David.
Oh, fantastic, Scott. Thank you. And please do ask questions. As I said, the more questions you ask, the more interactive this is, the more interesting it will be. So this presentation is really divided up into three big categories. So the first category is what should you be doing in terms of your accounting before you have funding or before you're pre-revenue. That's the first thing we're going to talk about. The second thing we're going to talk about is what you need to have up and running in terms of accounting and finance if you're going to go out and get funding. If you're going to go out and try and raise money, what do you need to have ready? What do you need to have prepared? And then the third thing that we're going to talk about is what you should be doing in terms of accounting after you have funding, after you already have some good revenue, and what things you need to put in place and how you should be thinking about your account. So those are the three different buckets that we're going to talk about today. In terms of the pre-funding, I really believe that this is not an area where entrepreneurs and founders should be spending money. So if you have an idea, if you've got a concept, if you've decided that you want to start a new business and you've quit your job and you're starting to dedicate yourself to that business all the time, I don't think that you should be spending any money on an outside bookkeeper or an outside accountant in most situations. It's just during that period of time, you're going to want to, you're probably bootstrapped. So you probably don't have any other money that you're relying on. You're probably just relying on your own savings, your own checking accounts. So I don't think it's a good area to spend money on, but I do think it's important to think about some simple rules, right? And the first rule, and probably the most important rule, is to segregate your personal assets and your business assets. So you want to keep your personal assets completely separate and different from your business assets. And so the easiest ways to do this are, first, when you start your business, open up a bank account for your business. Now you need to create a legal entity in order to create a business bank account, but that's a good housekeeping thing to do anyway. So set up a bank account for your business. And then if you're going to be spending money on the business, have the financial discipline to actually put the money into the bank account and then pull the money directly from the bank account, as opposed to using your personal account and pulling the money directly from your personal account. In the same way that you have a separate bank account, you should also get a separate credit card for your business. Now, sometimes it's a little tricky to get business credit cards. Some banks do a better job than others. If you're having a hard time getting a business credit card, then just get a personal credit card, but only use it for your business. Because what you're really trying to do here is you're trying to create an audit trail. Because at some point, someone's going to need to take all those transactions that you had, and they're going to need to put them into a system, and they're going to need to classify them. So you want to keep very, very clear records that are not muddied at all. So that are clearly, this was a business expense, this was a personal expense. I would also keep every receipt that you have related to the business. You don't need to keep a physical copy of it. You can keep a digital copy. The IRS says you have to have backup for any expense over $75. We just say just record all of it, just so that you can keep good, accurate records. And once again, to have your audit trail. And that audit trail is really just to make someone's life easier in the future and to make it much less expensive once you start to have accounting. And the reason I say don't do accounting on your own is that almost every time we work with a company that has tried to do accounting on their own, if they are not a CPA and if they do not have a degree in accounting, it's a complete disaster. And it's oftentimes a lot more work to go back and redo all of it than to start from scratch with things being very, very clean and having good records. So, should we go to the other thing about the big thing I'm going to focus on this slide is the last item. A second thing that you really want to do, in addition to segregating your personal and your business assets, is you want to make sure that you have really clean documentation around your cap table. So your cap table is the table that summarizes who owns the company. So how much you as a founder own, if you have a co-founder, how much they own, if you have employees that have stock options, what those stock options look like, if you have outside investors, who those outside investors are, and how much of the company they have. That's what a cap table is. And you want to make sure that right from the very beginning, when you're starting a company, you keep a really clean cap table. One of the areas where we see the most disputes and the most issues is between co-founders or early employees about how much ownership they have and what that ownership looks like and how it should be treated. So the second thing you really want to do from an accounting perspective is right from the very beginning, make sure that you have good, strong legal documentation about ownerships, about founding shares, and about stock options. Scott, I'm going to stop for just 1 second. Is there,
yeah,
so
we've got
a separation of personal assets and business assets. We talked about cap tables. Are there any questions at this point?
I think you may answer. I haven't seen your full deck, so I don't know if you're probably going to answer this, but there's a question from Sherry. She asked, what accounting system process should every company use? So I'm not sure if she's asking.
Yeah, so that's a good question. So
yeah.
we deal with systems, and we'll talk about that once you sort of start getting your accounting system up and going.
Okay.
We'll talk about that a little bit later. At this early stage, I don't actually think you should use an accounting system. I think you should keep records of all of your expenditures, and I think you should keep copies of your receipts. And I think you should separate your personal and your business assets. But unless you're generating revenue or there's a very, very large number of transactions going on, which usually at an early stage there are not, I don't think it's necessary to have an accountant. I don't think it's a good use of funds. Regine, you want to jump to the next one? But we'll talk about systems once you guys are up there. Okay. Oh, we just talked about cap tables. Very simple in the early stages of the company. Just keep really good records of this. Make sure that there's legal documents to support it. It's a tricky area, and little decisions made up front can have absolutely huge consequences later on. Okay, the other thing you want to be aware of is you want to be aware of what your compliance obligations are. And the big ones to think about are what your state and your federal tax obligations are. Also, you want to think about your annual registrations for your legal entity. So if you're a Delaware C Corp, you have to do an annual registration for that. If you're a California LLC, you have to do an annual registration for that. So you want to think about that. And then you also want to think about your business license for the locality that you're in. So state and federal taxes, registration for your legal entity, business licenses, and then if you have outsourced consultants that you use, you need to file 1099s. And if you have employees, you need to do W-2s. So those are the different things that you need to think about and you need to be aware of in order to stay on top of compliance. Now, you probably at this early stage, you won't have a lot of activities. So the reporting should be fairly straightforward and fairly easy, but you want to keep those things in your mind. State and federal taxes, legal registrations, business license, and 1099s and W-2s. Okay, so those are the things you really need to think about before you get any funding, before you have any revenue. Keeping good records, segregating assets, taking care of your cap table, and the 5 basic compliance things that you need to be aware of in terms of dates and when they're due. If you're going out and you want to raise venture funding or private equity funding and you want to get ready, you don't necessarily have to have really strong accounting records, but you do need to be ready to go out and do fundraising. And there's three things that you really need to have ready to go out to raise funds. And there's all sorts of presentations. We've done presentations here on this topic. And I think, Scott, we probably even have some of our fundraising presentations archived maybe, or maybe on YouTube, maybe not.
Yeah, and we also, so we work with about 200 startups here in SoCal region through our program, and we help them with pitch decks, pitch deck prep, investor prep, and investor introductions. So we can definitely help your startup out with that. We got a team of 15 mentors, and then we also bring in our partners and friends like Early Growth to help as well. You know, we might ask David to take a look at a deck that we're about to go out with to a group of venture capitalists just for his feedback or Regine's feedback. So yeah, we have a great process in place to help you with an extremely strong pitch deck if you're going to be raising professional money, angel or VC.
And for that process, you need an executive summary, a pitch deck, and an elevator pitch. But there's sort of two finance areas that you need to pull together. So if you're trying to get your first round of funding, there's two areas. There's two slides that you need from a financial perspective. And I think, Regine, we have so here's the pitch deck. There's 10 different slides. The standard guidance is that the pitch deck should either be 10 slides or 12 slides, depending on who you're listening to and who you're reading. But it's pretty basic in terms of what venture capitalists are expecting to see, especially if you're raising money at the earlier rounds, at the seed and the Series A round. So there's certain things they want to see. There's certain things they expect. Of those things that they expect, there's really two key financial slides that are important. And do you want to go to the next slide? So the first one is your top-down. It's your top-down projection. So the way that venture capitalists think about the market is that they're going to make 10 investments. And for those 10 investments that they make, they expect 5 or 6 of them to totally fail. They expect a couple of them to maybe break even. And then in order for the equation to really work, they need 1 or 2 of them to have really big returns. But in order for that math to work, those returns need to be bigger than 10x. They need to be very large returns. So when a venture capitalist is looking at a business, they're not looking to see necessarily if it's a good business. Oh, this is a good business, it'll make money, or it'll have a good return on investment. What they're really looking for is they're looking for a huge opportunity. They want to make sure that there's a really, really big opportunity that you can go in, build a business around, and take advantage of, and have that big home run. So this slide is just a slide that says, this is the overall opportunity in the marketplace. And this is the section of it that we think we can have. So this is the first finance slide that you need to prepare in order to get funding. And sometimes they have this information just online. Sometimes you can Google market sizes and you can find all sorts of interesting information and all sorts of interesting articles on it. There's also a bunch of different industry analysts that are out there, folks like Gartner and DataQuest. And what these folks do is they prepare reports on different industries. So you can get information that way as well. But really what you want to be able to do is just have this slide to say, hey, this is a really big opportunity. You should be investing in my company because you want to take advantage of this big opportunity. So that's the first thing. And the second slide that you need in order to go out and get funding is a bottoms-up projection. And this is a detailed budget. And it's a detailed budget that typically is a 3-year budget. It goes out 3 years. And a lot of times entrepreneurs will say, well, why do I need a 3-year forecast, or why do I need a 3-year budget? I have no clue what's going to happen, and anything could change. And it's ridiculous for me to be able to forecast 3 years out without having all the knowledge that I need. But part of why venture capitalists want to see a 3-year forecast is they want to see how well you are thinking, what type of strategic thinking you have. If you're thinking about the business in the right way, if you understand the different dynamics of the market, if you understand what your different costs will be, if you understand how you're going to achieve revenue, if you understand, what the relationship is between ad dollars and marketing and deal flow, they want to make sure that you're thinking through all those different things. So it's really important to have a 3-year forecast, even though we all know that an early stage company, even the most successful ones, they pivot back and forth and they change directions over and over again. It's still important to have that piece in there. And then I think, Regina, is there one on milestone financing? No. Okay, go back. Okay, if you go back, I'm sorry. So the other thing about this bottoms up forecast, the other thing that you want to make sure you do is something called milestone financing. So every time you raise money, you want to make sure that you're raising the money at a higher valuation. So every time that you're raising money, you want to give up less of your company because the valuation is higher. So for example, let's say you go out today and you just started your company and you raised $100,000. And that $100,000 was raised at $1 million valuation. So you basically sold off 10% of your company to raise that $100,000. And then 2 years from now, you're going to go out and you're going to raise another 100,000. Well, you don't want to give up another 10% of your company, because hopefully you've done all these incredible, wonderful things between now and when you raise money again in 2 years. And so your company has a higher valuation. So maybe for that $100,000 that you're going to raise in 2 years, maybe you only give up 5% of your company, or you only give up 3% of it. But in order to do that, you need to make sure that every time you raise money, you understand what are the clear milestones are that you want to hit with that money. So sometimes I'll talk to entrepreneurs, I'll talk to founders, and they'll tell me they're raising a round. And I'll say, how much are you raising? And they'll say, I'm going to raise this much. And I was like, well, how come you're raising that much? Or why did you choose that amount? And they'll say, well, it sounded good, or XYZ company did it, or I think it's what I can really raise. Those are all the wrong answers. What you want to do is you want to say, okay, what key milestones do I need to hit in order to make sure that my next valuation is higher than my current valuation is? What are the things that I need to achieve? Figure out what those things are, then build a budget for what it will take to achieve those things, and then give yourself a 20 to 25% fudge factor. Increase your budget by 20 to 25%, because things always take longer and they always cost more. And the last thing in the world you want to do is get 3/4 of your milestones done and not finish the whole thing. But so figure out your milestone, create a budget, add a surplus, then that's the amount of money that you should raise. So when you create your 3-year forecast, your bottoms up financial projection, milestone financing should be part of that process. You should understand how much you're raising and what key milestones you're achieving. So in order to go out and get fundraising, the 2 financial things you need are a tops-down model and a bottoms-up forecast. We have any questions, Scott? Are we good?
Yeah, I didn't want to, that was a good riff, so I don't want to interrupt you, but we had one from a couple slides earlier, which is that when deciding between an LLC and a C Corp or S Corp in California, which one makes it easier to control the finances, taxes, federal fees, et cetera? So I guess they're asking for, and obviously depends on what kind of company you're starting and if you are going to raise capital. I mean, but I think they're just kind of asking for a general breakdown of pros and cons of LLCs versus C Corps or S Corps.
Yeah, well, and I think you actually started to answer the question yourself, Scott, right? If you're going to do, the reason you want to do a C Corp is if you're going to go out and raise outside funds. So if you're going to have outside investors come in, a C Corp it's a much easier legal structure for that. Most venture capitalists, most PE firms will not invest in an LLC or an S Corp. They're looking for a C Corp and preferably a Delaware C Corp. Also, if you're going to have employees that you're going to be giving stock options to, it's much easier to do that through a C Corp. The disadvantage of a C Corp is that there's double taxation, right? So you get taxed at the business level and then you get taxed at a personal level. For an LLC, you still have some of the protections that a C Corp provides you legally. They're not as strong, but you do still have a lot of the legal protections. But it's much harder to raise outside money. It's much harder to give up shares to your employees. You can do it, but it's much more difficult. But you don't get double taxation. You're only taxed once.
So another question related to this slide specifically is from Kieran. I'm not entirely clear why this is called bottoms up.
So I think so. The tops down model is called because it looks at the overall market size, and then it says, "Oh, that overall market size, I'm going to get 2%." Right. So this market size is $10 billion. This is worth $10 billion in revenue, and I'm going to get 2% of it, which is going to give me $200 million. Right. And that's a tops down. So you're looking at it from a big picture. Bottoms up is because you're building it from the very bottom. So you're saying, okay. How many engineers do I need to hire in order to build this product? What months are each of these engineers coming on board? What's their annual salary going to be? What are my other costs for employee benefits and everything else that I need to add on to their annual salary? In addition to my engineers, am I going to be renting a space? How much is that space going to be costing? How many square feet is it? What is it? What's the average cost per square feet? All those different things. You're building it from the bottoms up. You're building a budget. It's kind of like you're building a house. You're building a budget from the bottoms. You're from the bottoms up. So from the beginning, from the ground floor.
So next question is from Chris. What are the average sales or budget projections you have seen for growth, specifically in tech? Percentages would be fine to communicate these projections. So I guess he's asking about a general, you typically see the hockey stick in most tech startup pitches. I think he's asking for what's realistic.
What's typical.
Yeah.
So Chris, it's very hard because it depends on the sector, right? So I mean, there's many different sectors in technology. There's biotech, there's life science, there's clean tech, there's enterprise software, there's business, there's B2C, there's consumer goods, there's food innovations. So it really depends. So there's no typical in terms of the revenue projections, but what the venture capitalists are going to be looking for is a really good, strong understanding of what your revenue model is. So for example, if you're in an industry that has direct sales, they're going to be looking to see that you understand what a direct salesperson's comp looks like, how long it will take that direct salesperson to ramp up, how many deals that direct salesperson can close on a monthly basis, and what the value of those deals are. They'll want to make sure that you understand that. If you're going out and you're building a B2C company that's going to be really, really relying heavily on Facebook advertising and Google advertising, and your investors don't have a problem with you spending money on Facebook advertising in today's climate. But if you're going to go out and you're going to do Facebook advertising and Google advertising, then they want to make sure that you have a good understanding of what it costs to buy AdWords, what the typical conversion would be for AdWords, what the typical sales would be. And so they're looking to make sure that you understand the dynamics of your revenue, how you're going to generate revenue and what it will look like. They want to make sure if there's comps that are out there in terms of companies that are in similar spaces, that you've talked to them, that you understand what they've done, that you understand what their growth curve has been like. In terms of the best way to think about how fastly you can grow is think about other companies that are in similar industries and how fast did they grow and what did they have to put in place for growth. But they're looking for knowledge. The last thing in the world you want to do is say, okay, I'm going to grow by 10% this year, and next year I'm going to grow by 25%. The following year I'm going to grow by 40%. If you put that into a deck, you'll get shot out of the water.
Yeah, definitely.
Yeah, you don't want to do that.
So next question is from Sherry. Can you provide us references to help us figure out milestone forecasts? So I think what she's asking for is, and that's again to depend on the industry. So for example, like we're raising capital for helping 5 of our tech startups raise capital, and it's different across the board. So one milestone might, if you're a med tech company, it might be getting a prototype device built in a certain amount of time. And if you're a B2C company, it might be launching your whether it's an app or a website and getting a certain amount of customer engagement or a certain amount of revenue. So I think the milestones would also depend on the vertical. Would you agree with that, David?
Absolutely, 100%. And I think the best way to do it is, so you can go out and you can talk to other companies that are in your vertical and see what their key milestones are. It's just a question to ask the venture capitalists, right? So, hey, what do you need to see in order for you to think there's an increase in value? What are the things I need to achieve in order for you to think I'm worth more? What are the indicators that you're looking for? And milestones have changed. Milestones have changed right now. So investors are looking to see more traction right now. They're looking to see more advances. They're looking to see founders get farther along than they have for the last couple of years. So milestones change and expectations change. But asking what other founders are doing, looking at what's happening in the marketplace, and talking to venture capitalists and investors are all good things.
And next question is from Marcus. I'll actually answer this one because his question is, can you help startup tech with pre-revenue raising fund via crowdfunding? So I think what he's asking is, we just actually helped 2 of our startups with what's called equity crowdfunding. So instead of like a Kickstarter, Indiegogo, where you're getting donations for a product or a film or a game or something you're building, you're actually giving up equity in your startup. And that is going to be tough for companies that are pre-revenue or pre-product to raise. Typically, the way it works is that you would want to have some type of product or service launched. And also the way the equity crowdfunding, at least in our experience, we've worked with some of the top equity crowdfunding platforms like Republic and Seed Invest and WeFunder. And the way that they typically work is you need to have built a certain amount of traction with your customers or users, because they won't actually typically start promoting your crowdfunding deal until you hit a certain amount of money raised. And then once you do, then they'll start promoting on their platform. So what happens to a lot of startups is they think, oh, well, I'll just get them to do the promoting for us and they'll help raise the capital with their platform. But it actually doesn't work that way. So you would have to have a compelling story that would get, equity crowdfunding investors interested and excited about actually putting money towards your startup, and doing that without a product or revenue or some kind of traction is tough. So we can talk more offline about it, but I think, Marcus, it sounds like you might be a little early for equity crowdfunding. And if you want to talk about Kickstarter and Indiegogo, we can talk about that separately as well. That's a little bit different deal. We've helped a number of startups with those as well. So we can talk, we'll have our contact info up later on. We can ping us offline. And then just since we're still on this slide, we have one more question about this slide from Kieran. Are all 3 steps, 1, 2, 3, going to be for a 3-year period or smaller period? But I think you did say 3 years on this bottom up, didn't you, earlier, David?
For the bottoms up, 3 years seems to be the standard right now. So that's what they're looking for. So typically, the way that we see it broken out is that year 1 is in 4 quarters, and then year 2 and year 3 is typically how we see it broken out, and that's how we prepare it for our clients. And I was going to say, Scott, I was just going to piggyback. I agree completely with what you're saying about crowdfunding. Indiegogo was a client of ours for 4 years, and I'm a huge fan of that platform. I love that platform. I think that the Indiegogos of the world can be useful if you're selling a product, especially if it's a consumer product, to get traction and show traction. So we've had several companies that have had a good showing on Indiegogo, and they've been able to parlay that into venture funds because they've shown that there's an appetite and a taste for it. But I completely agree with you, Scott, that for the early stage, if you're going out for that first seed round, that friends and family round, that seed round, you're not going to be able to raise the money on the equity platforms.
And also, just one thing I'll add, having been at one of the startups that I was part of, we did again, just to separate it out. So what David's Indiegogo is different than the equity crowdfunding platforms I mentioned, like Republic. Yeah.
It's very, very different, completely different business model.
Completely different. But what I will say is that on both of them, it is not a good signal. So for example, we had a decent but not great Indiegogo crowdfunding campaign, and that actually hampered us raising capital for the startup after that. So if you don't hit a home run on either equity crowdfunding or on the traditional Kickstarter, Indiegogo platforms, it does make it a lot harder to raise capital. So be very, very careful about, doing a campaign and not having it be successful. And it's not just like, let's just say a lot of Kickstarter campaigns will say, our goal is to raise 100,000. And then they might hit that 100,000, but actually the investors, at least that we work with, they would want to see you do like multi-millions over typically your goal in general, especially like David said, if you're a consumer facing product. So be really careful with crowdfunding, both crowdfunding and equity crowdfunding, if you don't have that kind of strength or you're not that far along. So we'll talk more offline about that.
Definitely do not do it. Definitely do not do it half-ass.
Yeah.
We had a company in LA that kickstarted. It was the second highest Kickstarter campaign of all time. They raised like $13 million. It was a hardware product. It was like a personal computer. I can't, maybe it was goggles, but and they were able to raise a bunch of venture funding because of it. But they made a bunch of wrong assumptions in their Kickstarter campaign, and they ended up failing as an entity. But it is not. You're absolutely right. It's not something to do lightly, and you have to think it through. And if you go out and if you do a Kickstarter campaign or an Indiegogo campaign and it's not successful, that will reflect very poorly on you.
All right, cool. Well, let's make sure we keep going in the deck too. We kind of got like this is great to have all those questions.
Should we jump? Okay.
Yeah.
Post funding. So we talked about what you need to do pre-funding, what you need to prepare in terms from a finance perspective to go out there. Once you're funded, if you are set up as a Delaware C Corp, or if you have outside investors, you need to use accrual accounting or generally accepted accounting principles. And this is where we get into sort of the boring piece of this presentation, but it's important to know. When people talk about accounting, they really divide accounting into two different buckets, something called cash accounting and something called accrual accounting. And cash accounting is just follow the dollars. So you own a store, someone comes into your store, they give you $20. That's revenue the second you get the money, and that's positive revenue the second you get in the money. Let's say in that same store, you buy inventory on a weekly basis. So on Monday, you get $10 from selling something. On Friday, you spend $100 on inventory. When you pay for that inventory, that's your expense. Cash accounting just means the accounting follows the dollars, just the physical dollars where they are. Incoming is revenue, outgoing is expenses. It's the most simple, easiest form of accounting that there is. Most small businesses use cash accounting. It's easy and it's simple and it doesn't require a lot. The other type of accounting is accrual accounting. And accrual accounting is required if you have a C corporation that has over $5 million in revenue. So, you know, a lot of C corporations have under 5 million and never get to that point. So they don't necessarily need to use accrual accounting. But if you're going to get outside funding, equity funding, if you're going to get venture capital or private equity funding, or if you're going to be relying on a lot of credit from a bank or from an other lending source, there's often a requirement that you need to use accrual accounting. And most venture-backed companies at some point grow beyond $5 million if they're successful. And so obviously they need to do accrual accounting at that point. So it's always a good idea. It's always a good idea to start with accrual accounting. So if you are a company that is planning on being a C Corp and planning on raising outside funds, you are going to need to use accrual accounting. Now, where cash accounting just follows the money, accrual recognizes revenue when it is earned and recognizes expenses when they are incurred. So to give you an example of what that means, let's say you are a software as a service company and you sell an annual subscription for $12,000. Now, if you sell that subscription for $12,000 and a client is required to pay you up front, so you sell the subscription for $12,000, a client pays you $12,000. Under cash accounting, you're going to recognize that $12,000 as revenue right when you receive it. Under accrual accounting, you're going to recognize that revenue as you earn it. So every month, you're going to recognize $1,000 because every month you've earned a 12th of that annual subscription. So you're recognizing revenue when it's earned. In the same way, you want to recognize expenses when they are incurred. So if you're using cash accounting and you go out and you get an insurance policy for your business, and it's an annual insurance policy and it costs $6,000. Under cash accounting, when you paid that $6,000 up front, That would be your expense, and you would recognize it then. Under accrual accounting, you would recognize $500 of the expense every month as you were incurring the expense. So cash accounting, accrual accounting, important to know the difference. The rules governing how you do accrual accounting are generally accepted accounting principles. So remember before I said, don't do your accounting on your own because you're always going to mess it up. Once you get funding, once you raise money, if you are going to be going down especially if you're going to be going down the accrual accounting route, you want to have a professional doing your books. Should we go to the next slide here, Regine? You're going to want to have a professional doing your books. And you can either hire someone full-time or use a firm like ours where you're doing someone on an outsourced basis, or there's also individuals that do it. So depending on sort of what your needs are, how sophisticated they are, whether you need high-level strategic assistance or you just need bookkeeping, whether you have outside investors or not, whether you have revenue, there's all sorts of different decisions that you need to make in terms of the type of person to hire. But if you're going to have a Delaware C, if you're going to have a C Corp, if you're going to use accrual accounting, you need to hire someone. They need to use generally accepted accounting principles. The first thing they do when they come on board is they will set up a chart of accounts for you. And this is a classification system for how you deal with your revenue, your expenses, and your assets and your liabilities. Go to the next slide, Regine. Okay. If you didn't understand what all those things that I just said meant, we'll go through all of them right now.
Hey, so, David, before you do that, can I just ask two questions?
Sure, absolutely. Sorry,
and also, we're also just as a time check. We got about 15 minutes left, so.
And we got we got 3 slides left, I think.
Oh, good. Okay, cool. So one question is from Sherry. She asked, if we don't need to raise funds but want to be assured that we are spending our available capital to build and grow our business effectively, are there references available for effective budgeting? So I'm not sure if she's talking about, like a QuickBooks, or she's talking about solutions like that, or she's talking about, are there videos or other training available to help with effective business budgeting? So I guess maybe, Sherry,
well, we're doing a class with you on budgeting. I think we've already done one, but we could do it. I'm sure we'll do it again with you as well.
Yeah, I was going to say maybe we'll do that as a future thing, and then
we've got one on budgeting. I don't know if we've done it with you yet or not, but we have a budgeting one. So that would be a great resource.
Okay, so Sherry, ping me after, and we'll try to answer your question in more detail offline. And then I had a question, David, because this is something that especially a lot of our first-time entrepreneurs and founders get confused with. Can you just talk a little bit about the difference between? A lot of times they'll say, "Oh, well, I need an accountant." And what they actually need is a CFO or someone who's. Can you talk a little bit about the difference between a CFO or a finance person and an accounting person, just in terms of, especially for venture-backed startups?
Yeah, no, absolutely. So I actually divide the world sort of into 3 categories. So I look at it as CFOs, accountants, and bookkeepers. And for a bookkeeper is, in my mind, someone who is just going to be entering general ledger entries. They're just going to be putting entries into an accounting system. They typically just use cash accounting, and they're just recording all of your transactions, and they're not doing anything more. When I think about an accountant, it's someone who oftentimes has a CPA, but they understand accrual accounting. They understand the correct way to recognize revenue. They understand how your equity should be treated in your financial statements. They understand how you should be amortizing your intangible assets and depreciating your other assets. But they understand all the complexities of accounting. They have a degree in accounting. Like I said, oftentimes they have a CPA. That's an accountant. They're the ones that would handle your books, that would clean your books, that would create your financial statements. The third thing, the third area is a CFO. And for me, a CFO they're an executive. So they are someone who has a strategic perspective on the business. They will oftentimes oversee the accounting function and make sure that the books are clean and done correctly. But where they really bring a lot of value is in helping you do things like create a forecast for your business. They help you figure out things like, what is your burn rate, and what are the key milestones that you'll be able to achieve with the money that you raise, and they help with things like the fundraising. Oftentimes the CFO also handles the legal relationships. They handle, oftentimes for smaller companies, they handle HR and they handle human resources, things like payroll, employee benefits, and they also handle things like facilities and a bunch of the other, and insurance, a bunch of the other sort of key relationships and partnerships that are necessary for an entity to thrive and grow.
All right, great. Thanks.
Cool. Okay, we're just going to go through the financial statements, and I think we're kind of there. So,
Okay, great.
So let's go back real quick to the income statement. And this might be really basic for people, and if it is, I apologize. But once you have, if you've raised funding, once you have started to generate revenue, once you start to really have financial activity, you're going to want to have financial statements to keep you appraised of your business, and also if you have outside investors, to keep them appraised of how your business is doing. And there's 3 traditional financial statements that are really important for all businesses all over the world. The first one is your income statement. And your income statement is it is over a period of time. So it could be an income statement for the last 12 months. It could be an income statement for calendar year 2019. It could be an income statement for the first 6 months of 2020. The amount of time can vary, but it's always for a period of time. And what your income statement has on it is it has your revenue. So how much revenue that you've generated. Then it has your cost of sales or your cost of goods sold, the costs that are directly attributable to your revenue. And if you take your revenue less those costs that are directly attributable to them, you get your gross margin, and then you have your operating expenses, and then you have your earnings. So that's your income statement. Revenue, costs directly attributable to them, gross margins, your operating expenses, and then your profit. That's your income statement. The second statement the second common financial statement is the balance sheet. The balance sheet is at a specific period in time. So whereas the income statement is over a period of time, the balance sheet is at one specific point in time. And it is, what are your assets and your liabilities at that given time? And the way that the balance sheet is broken up is on the left-hand side is your assets. Those are the things that you own. So if you're thinking about your personal assets, it would be the amount of cash that you have in your checking account, the amount of savings that you have, the house that you own, the car that you own. Those are all assets. Then on the right-hand side, you have your liabilities, which are the things you owe. So if it's your personal, if it's your personal life, it would be your credit cards. It would be your utility statements. It would be the loan on your house. And then whatever's left over between your assets and your liabilities is your net worth, or for a company, your owner's equity. And then the last sheet is the statement of changes in cash flow. Like the income statement, this is over a period of time. You can set the period of time, 1 month, 3 months, 6 months, 12 months. And it just shows how your cash balance has changed during that period of time. What has happened to your cash? Because in accrual accounting, remember, cash and revenue and expenses do not always align perfectly. So the statement of cash flows shows how your cash has changed. So those are the basic financial statements you're going to need to start preparing. Is that the last slide, Regine? Cash burn. You really want to make sure you understand your cash burn, especially if you're a venture-backed business, how much cash you have, how long it's going to last you, what your key milestones are with that. Okay, and then I had one question that we had earlier, Scott, that I thought was going to be addressed and it wasn't addressed, and that was just systems.
Definitely.
Yeah, I don't think people should spend money on an accounting system until they've raised funds or until they start to generate some real revenue. But once they have raised funds, there's a lot of different systems that are out there. Depends on the complexity of your business and what you're trying to do. But if you're planning on being a venture-backed business or a PE-backed business that's going to have strong growth and scale, and it's going to scale quickly, or at least that's the target, then the most comprehensive systems that are out there at the lowest cost point are either Xero, which is a New Zealand-based company, or QuickBooks. And that's what most of our clients use. And that's sufficient for most of our clients until they get to about 15 to 20 million in revenue. And then they tend to migrate to a larger, more expensive system like an Oracle or a NetSuite. But most of our clients start out on QuickBooks or Xero.
And for those of you who don't know, PE is private equity.
I'm sorry.
So we have a time for a few more questions, but first I'll just say thanks so much, David, for walking us through that. We really appreciate it, and Regine as well. But if you do have a question, some of you that joined late, there's a Q&A button there. You can hit the Q&A and type in your question. We'll ask it live. We're going to do a question from Chris, kind of back to an earlier discussion we were having. He says, do you think accounting and HR should be separated?
Hey,
so I guess
I think that is, yeah, I think that is, I think as a company grows, I think it's easier to have more and more different divisions of labor, right? So I think when you start out a company on marketing, you might have one marketing person. A large enterprise company is going to have someone that does PR. They're going to have someone that does marketing communications. They're going to have someone that does marketing events, and they're going to have someone that does product management. I think when you first start out a company, finance and human resources are often controlled by the same person. They oftentimes report into the CFO. For most of my career, I've been at small enough companies where I've owned HR. But as a company grows and increases in size, it's great to have someone that's really dedicated to HR, that knows HR really well, and that can perform an executive level. But typically, when you start out, they're separate. It's a cost thing. My advice would be to, in the same way that you're going to outsource your finance and accounting, is to outsource your HR as long as you can as well.
That's what I was going to say. Yeah, I think for most startups, that makes sense. We have a question from Thomas. What are the biggest, most common mistakes that startups make? I guess I think let's just keep it in. There's so many we could talk about. Let's keep it in terms of, for financials and accounting probably.
Well, so I mean, one of the things that I've talked about several times during this call is, or this session, is doing the accounting when you don't really have a background in accounting, right? If you don't have a degree in accounting, if you don't have a CPA, thinking that you can do your own accounting is, if you didn't have a background in engineering, you wouldn't go out and try and write the code for your company, right? You would hire someone that knew how to do it really well. Accounting's the same way. So understanding that you need a professional to do it, and that it's an important function that you need to hire someone that has experience with. I say that's the first thing. I'd say the second thing is that milestone financing piece that we talked about, which is really when you're going out to raise money, really having a good understanding of what you need to accomplish with that money and what you need to achieve, so that there's an alignment between your investors and your company. I'd say those are two things from the talk we had today to think about. But as you mentioned, Scott, so many ways to make mistakes.
Yeah. So another question: what are the benefits of outsourcing a CFO?
So the biggest benefit is that early stage companies oftentimes really need that strategic CFO support. And they need someone that's done this before, that understands the XUs and the complexity, but they don't want to pay $350,000 a year for that person, right? It just doesn't make sense, because you really might only need that person for 5 hours a month or 20 hours a month. So it's much cheaper, but you still get that same level of expertise and dedication.
And I'll just say that, definitely agree with that. I think that especially for, many of the startups we work with, as I mentioned, with our EPIC program at UCR, are a lot of first-time founders, also a lot of projects that we're bringing out of the research labs, and we're finding executive talent to come in and help build the startups. And typically, it's hard enough to raise capital to bring on a CEO. We actually are using a lot of fractional CEOs as well at this point, just because, again, bringing a CFO on that's non-fractional, I just don't think is typically a great move for an early stage startup, especially if you're in the angel or early, what we call seed stage VC round. So definitely, I think that's good advice from David. And we recommend to all of our startups that they work with a group like Early Growth or others or other fractional CFOs who are talented, as opposed to trying to bring someone on full time. Chris asks, how does a PE or private equity firm approach an investment in a startup versus a VC, specifically from reviewing the books and software?
So, so venture capital is actually a subset of private equity. So venture capital is a type of private equity, and venture capital is the piece of private equity that's typically interested in high growth technology plays. So the venture capitalists are typically the PE folks that are doing the early stage investing in high growth technology plays. PE firms that are not venture capital firms typically are investing in more traditional businesses or more traditional sectors or later stages, but VCs it's a subset of PE.
Okay, that's great. And we got to wrap up. I just we got one last question. And while you're answering that, I'm just going to put our contact info for our program, which is called EPIC Small Business Development Center at UC Riverside. And as I mentioned, we work with a number of couple hundred now startups in the region in Southern California. We especially focus on Riverside and Riverside County and Inland Empire, which includes San Bernardino County. There's a lot of underserved businesses and founders out here. So if you are out here and you need help, let us know. Our contact info is there. And last question before we roll out. I should also mention that David and his team have also graciously donated 30-minute blocks of mentoring time after these 1-hour presentations or webinars. So if you're interested in those, ping this email below and we'll get you set up with that link. And so last question, is it good to hire a CFO based on a stock option plan? So I think the question there is
CEO, did you say? Or did you say CEO?
CFO, sorry, CFO based. I think the question is more about hiring based on equity as opposed to not having cash to pay someone. So again, I think that's case by case, but if you have a want to weigh in on that before we jump to the one-on-one mentoring sessions.
No, I think it's on a case by case situation and depending on what you have and at what point you're bringing in a CFO. So typically you're not hiring a full-time CFO until you get close to your growth round of capital, which is close to your Series C. You typically aren't hiring a full-time CFO until that point. And that CFO, when you hire them, you will have cash. They will want cash, but they'll also want a big equity grant. I'd be very leery of someone at an early stage who was willing to do CFO services for you for equity. First of all, I'd be leery of what their credentials are and how they're supporting themselves. But but if that's it depends on the situation. I agree.
Okay.
So where are we going? Where are we staying on this line? Where Regina?
So I put the link to the one-on-ones in the chat there. If Regine, can you see that? Can you guys see that in the for the not the Q&A but the chat? And we'll jump over to that next link. Can you guys both see that?
Yep. So should we just? I'm going to jump to that right now. Is that okay?
Yeah. If you guys jump to that, that's great. I'm just going to end this and yeah, thanks everyone for joining us. This will be on. Thank you, and thanks to David and Regine and Carolina for helping set this up. And we're going to end this now, but our contact info is here, and we will see you soon. We'll see you in 2 weeks on Finance Fridays. So thanks a lot. We'll see you soon. Bye.